So day two, this is day two of the boot camp. And what this is going to focus on is a pro's mindset and analysis. And the reason that this is day two is because before you really get into the technical aspects of trading, you have to know day one was the language of trading. And now that you know the language, you have to know how to process what what the different aspects of Forex is and know how to analyze the markets or know what types of analysts or analyzation there is in the markets. So the reason this is important is if you go and try to learn the technical aspects of trading without knowing this first or knowing how to process what you're learning, then you can learn all the strategies in the world and you won't be able to make the results that you want to make. So that's why having this as day two is really effective, because now that you have the right mindset going into day three, where we start getting to some technical aspects of things, you'll really be able to understand what to do and it'll stick with you versus, you having empty knowledge. You don't want to have empty knowledge. You want to have your knowledge be sound knowledge. So this is going to be very important as far as giving you sound knowledge. So the first thing is knowing the difference between a pro and an amateur approach. Because if you don't know both sides, then you won't know which side you're on. So an amateur, I'll just say rookie. Difference in a rookie and a pro. So a pro understands that the first thing is that a pro understands long-term mindset. So a rookie wants, like crypto says, wants to moon tomorrow. And if you don't know what moon means, it's just basically flipping your account over and over and over again in a very short amount of time. It's a crypto term, but I will use it here. So they want to make money faster than they're able to. So overnight, we'll just do that. So that's one thing for a pro. A pro is going to know the long-term mindset. I'm going to show you why that's important. So if we start with here, knowing the long-term mindset. Let's say, trading, you got your job, you got trading. Well, at your job, you would be working 30 to 40 years to be able to live off the interest of what you make. Interest of income. Now, in trading, if you could take the next some people can get it done in one, but 2 to 4 years to be completely independent, completely living off the interest, in trading. And a lot of people say that's long-term mindset, which is crazy. 2 to 4 years is long-term mindset, but the people that think 2 to 4 years is long-term mindset are people that don't have great financial sense. And when you really think about it, after this, right? So after the 30 to 40 years, you have what's called, I call it stagnant money. Stagnant money. So stagnant money is money that doesn't grow. So money that you don't use, any money you can use to make more money, but money that you don't use to, it doesn't continue to produce any more results. It's there, it's stagnant, it's not doing anything. So that is the stagnant money you live off of. In trading, you have what's called, I like to call it income money. And this is what, and not all money is income money. So basically money that works. Like money that works in a way to where it generates interest. So you have stagnant money, and I call it income money. It's the money that produces more income. And people would think the money that hits your bank account is income. Well, it is in regular terms. But the wealthy know that the first, I call it the first generation of your income, should only be, you should get to a point where the first generation of your income, the income you directly make, only funds the machine that builds you more wealth. And I know income money isn't like the technical term, but that's just what I call it. And it's different, because it's not stagnant. So if you had $3,000 in your bank account, it's going to stay $3,000. But if you had $3,000 that was producing you interest and you lived off the interest, well, the $3,000 stays, but you really made more than $3,000. Which scenario would you want to be in? That's the difference right there. Just between, the mindset of rookies and the mindset of pros, or mindset of wealthy, mindset of people that are not wealthy. The other aspect of trading, pro mindset, trading is a business. Rookie mindset, trading is gambling. That's a big difference there. So thinking of trading as a business, when you think of trading as a business, you're looking at the individual moves that you're making to grow your business when you have a business. So the moves that you make to grow the business in trading is being able to understand where you're placing your trades, what direction you're placing your trades in, most importantly, why. So businesses, I'll put it down here. Businesses has a plan. People say gambling, is a plan, but that's just really just, hey, if I lose this money, I'm out. Gambling is random, so it's emotional. Gambling is random and emotional. So if you have a plan when it comes to trading, then you understand where your areas of opportunity are. You understand where you're strong at, and you understand why you're doing the things that you're doing. But if you're just placing trades out of the fear of missing out, you will lose your money. It's simply that simple. FOMO trades are not part of your plan. And when you go outside of your plan in trading, you lose. It's as simple as that. The other pro mindset is trading is strictly logical. And then rookies, they are emotionally attached to trading. They're emotionally attached to trading. So when you have, your logic side of things, because you're looking at, this is what I'm looking for, this is how much I'm putting in, this is the percentage risk that I'm doing. and that's my plan. And I'm going to run that plan until I feel the need to tweak it. Well, as a rookie, they just want to trade because if they feel like that they're not in a trade, then they're not, I guess, worthy of being a trader. Like it's a weird thing that people have that are brand new. They feel like they absolutely have to be in a trade at all times, or they're not maximizing on their trading, I guess, adventure. So these are some core mindsets when it comes to, the difference between a pro and a rookie. Now I have this blueprint here, and this is something that I look at every day when I'm going over my trading, is that I understand the mindset of my journey. And this usually, a lot of people teach this a little bit later in a course. I believe if you know this early, before you even know how to trade completely, if you make your rules, your mindset, your mental rules, when you have the technical knowledge, you'll be able to apply it better. So these are things that I go by. I'm a successful, disciplined, fearless Forex trader. And these are things I put in my head. I enjoy the process of trading for the lessons and the profit. And I'll definitely link a copy of this. But these are mindsets. I'm not going to read every last one, but these are mindsets. Let's see. Share. Link, copy link. All right, I'm gonna put it in the chat, and then if you're watching the replay, I'll have it on the description. So these are things you must agree to when it comes to trading. Like it may not be these exact words, but if you look over it, I always continue to educate myself. This is a skill. This is a business. It's a journey. If you're a chef, you're always learning new recipes. If you're a musician, you're always learning new songs. This is a skill. This is part of you, because it's going to give you the life that you want. You'll be able, when you know that as long as you can see, as long as you can breathe, no matter if you were paralyzed, nothing, that you can make money because of the skill, then you have a new freedom in yourself when it comes to life. Because you know that you can take care of yourself no matter nobody fired you, if a business went bad, if the economy sucked, you could still make money in this market. This is the most important to me. I have a set of rules that make sense to me and are easy to execute, easy to obey, and I obey these rules. So these are different things. This is another one that's really big. If I find a setup, I follow my trading plan to assure I trade accordingly. I trade for risk to reward and not money. You trade your plan. When you learn how to do that, then you'll become a great trader. So now that's with that part of things. Now here comes the other part of trading that's most important. Knowing your numbers. Knowing your numbers when it comes to trading. A lot of people don't know what their numbers are. So you learning this is very important. Let's say you have a goal of making 2% a day trading. Now, you may see different things on YouTube that comes to, I turned $700 into $80,000 in 2 days. But it's guys, they've been trading for a long time doing that. And a lot of people see those YouTubes and they want that result in 2 weeks. And that's not how it goes. That's not how real trading goes. I mean, if you can do that, it's great. Of course, it'll be fun, but that's not the reality of every successful trader. The real reality is knowing what their plan is following along where things go. So let's go here. $2,000, right? $2,000, and your goal is to have a 10% a week return. It's your goal. Now, if you go, now the rookie would look at these first 4 weeks and be like, well, I can't buy a Ferrari off of this, not this plan. Just off of the first 4 weeks. Oh, it's week 8. Only did $400 that week. That's not enough. It's not Instagram flexing. It's what people really think. Like I've sat down and I've mentored a lot of people when it comes to this, and a lot of times people's mindsets are so messed up they can't really learn it. So this is why this is in day 2. But if you understand financial freedom, if write this down if you're taking notes, financial freedom is the ability to live off the interest of what you make, or the interest or the residual of what you've done. That's financial freedom. So you go down half a year, things start getting pretty interesting. Now, you're not going to have 10% every single week. This one may be 6%. You may have a good week and do 15%. You may be 8%, 11%, but it'll average. If you have an average and it averages out around that, then this will be relevant to what you make. And this is how you grow as a trader. It's that compounding. You compound as a trader. So now, because you're compounding, if you need something, it's there. You don't have to, if you need to withdraw $10,000 for something, it's there. That's the mindset of trading. Now, of course, most people will withdraw if they're 10% a week every week. Human nature, life, you'll withdraw. So it may not compound as fast as this because of life. But this is what would happen if it did. So that's the mindset of trading. That's the mindset. Even if it was, let's say, okay, I don't believe I can do 10% a week. Maybe that's too much. A lot of people, they do try to do 10% in a couple days or a day. But let's just say, maybe I'm not that good of a trader. Let's do 5%. If you're compounding, it doesn't matter what you're compounding at. If you're able to do something positive and compound it, it will pay off. So this is where a lot of rookies make the mistake. So now that you know the aspect of trading when it comes to, having a pro mindset with it, and then understanding where you are or what your reason is for trading a certain trade before you trade it, and not trading emotionally, now you can learn. If you understand and you agree to that, now you can learn how to trade. So let's go to the second part of day 2. The second part is understanding the types of analysis. So let's move this along. So you have the types of analysis. So when it comes to trading, there are 3 main analyses. There is technical, there is fundamental, there is sentimental. Those are the 3 main types of analysis. So technical analysis is basically, like charting, looking at price patterns, and different levels in the market to determine, a decision. So that's the actual marking up of charts. Fundamental knowledge is using world news and economic news to create, and a lot of traders would say just create a bias. So basically, because when you understand news, or like say if you're debating something, then you take one side of the debate over another, because when you debate, it's literally this or that. You can't be a great debater if you always take both sides. So in trading, it's creating the evidence. You're looking at the news to create evidence to take a particular side or particular bias in the markets. And the sentimental analysis is basically that bias, but as there's a difference, but it's a market bias. So what are most people thinking? Or more importantly, what are institutions thinking about a certain pair or a certain asset? So those are the types of analysis. Now, I'm going to show you how to, identify each type of analysis. And then if you have questions, go ahead and put your questions in the chat, and I'll check in about a few minutes. So this is a tool called MyFX Books right here. So this is for sentimental analysis. So if you go to MyFX Books and you hit community, and then you hit Outlook, general, you would get basically the sentiment. Why is it general? There it is, sentiment. And what this shows you is what people are thinking, or what more so, because MyFX Book also tracks a lot of Forex accounts, what positions people are taking in the market. So, for example, the majority of the positions using the data are buy positions in Euro USD. And then the majority of the positions in USD JPY are sales. This is what you could kind of use as sentiment, because you're seeing what people are doing in the markets. The other aspect of it, when we go to fundamental, is you would see, the economic count. This is the fundamental analysis. And the way that you identify this, let's see if I can go back. Custom. Let's go backwards. Let's go. So this gives you an idea of, what different economic reports came out. This is how you read it. It's very simple. What you want to pay attention to is high impact or medium impact news. If there's three main factors when it comes to news. You have your consensus, which is what people project. Other websites may say projected amount. And then you have the previous reports, and then you have your actual. What you mainly pay attention to, like if you're just starting out, is the consensus and the actual. So here's the rule. Like this is Euro, right? This is German news, but German is part of European Union. So German is part of the European Union. And I'll show you how kind of like fundamental and sentimental kind of go together in some aspects. So right now, you see that these three news reports, things were as expected. because you had your consensus, what people were projecting before the report came out. When the report came out, you have the actual report. What happens is if the report is worse than what people were thinking, then that's bad for that particular currency, like as far as strength. It's bad news. If it's better than what people are thinking, then that's good news. And then you couple that with the fact of what type of news is it? Is it high impact, medium impact news? So let's see if I can go to last week. I think Friday is always a busy day. So GBP news, a lot of negative news. If we go to GBP on Friday, what may happen is that you see GBP have a sell-off. So let's go. You may have GBP have a sell-off on Friday. So this was, when was Friday? I think Friday is here, right? Yep. So the news came out. This is where the news came out. So the news came out during the start of London session. So during the start of London session, the markets went down. It was downward news. And during that time, the markets went down. That's how you approach fundamental analysis. Now, with sentimental analysis, if there was a lot, like for example, Bitcoin would be the easiest example of sentimental, or no, gold. Gold would be the easiest example of sentimental analysis. If, like, say in America, everybody knows people printing, currencies being printed too much. Well, because of that, everybody agrees that gold over a longer term period, or silver over a long period of time, will continue to go up. And there is an optimistic price value. There's an optimistic outlook on price because of what's going on either on the charts or either in the world. So like sentimental analysis comes from a combination of technical and fundamental. It's like the market's reaction to what's going on. So with Bitcoin, for example, Bitcoin is kind of a split sentimental value. It's bullish for people that understand crypto, but if you look at the market as a whole, you may have people, it may be 50-50 to where people think, Bitcoin is not going to go nowhere. You still have that majority of people that think that, where like a lot of people that may understand crypto more will say that, crypto is going to continue to go up because of the nature of the technology and the use cases of it. So in that regards, if you take the combination of both sides, you would kind of have a neutral sentiment. But nobody really is going to say that gold is going to go down, because the market sentiment on gold is positive. Market sentiment on silver is positive. The market sentiment on the cannabis industry is positive. So that's how you determine between the two. The market sentiment on AI technology is positive. People think it's going to continue to go up. So let me see. Let's go. Where was I? I forgot what pair I was on. Let's see here. Well, I don't need it. So that's the next. So you had technical, sentimental, and fundamental. Does anybody have any questions on the fundamental aspect of things? Let's see here. We'll use this. All right. So let's go to the next part. The next part of the analysis is knowing how you're reading your charts. So if you go here, there's different aspects of the chart. So you have what's called, let me come down here so you can see it. This is what's called the candlestick charts. What's unique about a candlestick, and I'm not going to go into this too much in detail, but the candlestick, just so you know how to read it, we'll just do that. So a candlestick, the opening price, let's say this is a green candle, right? Like a bullish candle. So the opening price on a bullish candle would be at the bottom. So this price here, that would be the opening price at the bottom of the candle. The closing price of a green candle would be at the top. So during this 1 hour period, the market went from this price to that price. Now, candles have something unique, what's called wicks. Wicks show price movement extended beyond the opening and closing price. So a price went higher than where it closed, you'll have a up wick, like a bullish, not a bullish wick, it's a wick at the top. If price went below where it opened on a bullish candle, you would have a wick at the bottom. Zoom in. You would have a wick at the bottom. Let's see, that's not gonna let me center it. So that's how you look at the markets as a whole. I mean, a candlestick as a whole. Now you have the other aspects of a chart. Yeah, what's called a line chart. Now a line chart is going to differ. It's going to differ from a candle. A candle is going to show you everything that's happened in that hour, right? A line chart is only going to connect. So basically, this is how a line chart is formed. Let me find this. So let's say you have a closing 1 hour close. It was there. The price closed there. The other hour, the price closed there. The next hour, the price closed there. And a line chart would just connect the dots. So it only focus on the closing prices. And that's how a line chart is formed. Where a candle chart will give you more information of what happened during that hour. Those are the main two charts that are used. So you have the candle chart and you have the line chart. Now, a line chart can help you identify common closing prices. And a lot of people like to use that as part of their analysis, or just to simplify where a trend is going. Like say if they don't want as much noise. But if you're looking for detail, that's where you would use the candlestick charts. So here's the next aspect of the candlesticks, right? The candlesticks, as you can see, usually are in two different colors. One to signify a bullish candle, and another, which is commonly red, I just use white, to signify a bearish candle. And with bullish and bearish, bullish just means like uptrend or up, bullish means up, or bullish means buyers. Bearish is sellers or down, like bearish just means bearish is down, bullish is up. Like if you think about it, this is how I remembered it when I was first learning. If you think about a bear always attacks down. It raises up and then it attacks down. Where a bull always starts low and raises up. So that's how you can remember, between bullish and bearish. Is they move, bullish moves up, bulls move up, bears move down. A bear will fish, of course, going down. That's one way to remember it. So just to review on the candle itself, let's just use a downward candle as an example. Change the color. Down candle, the opening price. There we go. Oh, no. The opening price is always going to be at the top. So, for example, this would be the opening price. And then on the downward candle, the bottom of the body would be the closing price. Opening price, closing price, and then this area here would be considered the body. See how that displays. So let's do inside center. This would be considered the body of the candle. This part here, the top part of wick would be the price is high, so the high of that time frame. So in this case would be the 1 hour. So the highest price during that 1 hour period. And then let's move this. And this right here, the bottom of the wick would be the low price. So the lowest that that price had went in that hour. That's how you understand like the candlesticks right there. So you have the body, that's basically the distance between the opening and closing price, high and then low. See here. Let me check for any questions. Is everybody following along? Everybody doing good? I just want to make sure, do a quick check. Let me know if y'all are getting some value. Perfect, perfect. Just make sure. So we got the mindset, we got the types of analysis, and then just the basics of how to read a chart. So that concludes day 2. Now I hope that everybody got some value out of this. The recording will be up soon. And be ready for day 3 because we're going to start getting into the good stuff. So y'all have a great rest of your night. We make sure that everybody, there's no other questions. Let's see. Determines. So let me answer this one question here. What determines an opening price and a closing price in comparison to the low price and the high? So it's a great question. So here, if we go back to this, the opening price is the price literally the first second the hour starts. So whatever price that is, that's the opening price. Now, in an example of, a candle with a wick, what might happen is you have price open here, then it could go up, then it could go down a little bit, and then come back up to close. So something like that, like price will move in a way like that. Because not every candle, the highest price is the closing price. Price could have went down and then close, just like what happened here. So that's how you know, like, the difference is based off of the opening and closing price is based off of the first second and the last second. The high could happen any time in between that. The low can happen anytime in between the first and the last second. So yes, the closing price after 1 hour, the closing price after 1 hour has elapsed. So with that, that concludes day 2.